Hello and welcome to this 28th post of Investing Not Rocket Science. Investing doesn't have to be rocket science, and this is our non-expert guide to portfolio management. Last week Friday we looked at the FOMC and ECB interest rate decisions. You can read about it in post 26. Today we begin with the interest rate decision from the Bank of England. According to the policy summary released on May 11th, Bank of England's committee has voted to raise the interest rate by 0.25% to 4.5%. And UK GDP is expected to be flat in the first half of 2023. Although, according to the statement, the underlying output, excluding estimated impact of strikes and extra bank holidays, is actually projected to grow modestly. Economic activity has been better than expected, and the demand is expected to be stronger than expected in the February report. Unemployment rate is expected to remain under 4% until the end of 2024. CPI inflation was 10.2% in quarter one and is expected to fall sharply from April 2023 as large price increases 1 year ago drop out of the annual comparison. Food price inflation is likely to fall slower than expected in the February report, and inflation is expected to be below 2% in a 2-year horizon. So you see here the interest rate expectations and inflation expectations. A quick recap of this blog series, Investing Not Rocket Science. So far, in the first episode, I defined a basic portfolio framework. The objective of this $1 million portfolio is to beat inflation and an equity index. The investment style presented here is active portfolio management without the use of leverage and a time horizon greater than 5 years. Typically, there are 2 posts a week, which includes details of the portfolio and actionable evaluations, Mondays and Fridays. From posts 2 to 20, I've analyzed and evaluated about 67 stocks and 4 potential bond additions, and this portfolio is long 16 stocks, 1 bond, and short 1 stock. Posts 21 to 27 were focused on the Q1 2023 earnings announcements, particularly of stocks in the portfolio and in the watch list, and of the economic data. You can read all about it on www.claritech.app. Okay, in this post, we're going to look at the BoE interest rate decision, and we're going to look at evaluating Disney along with some of its peers, such as Netflix, Paramount, Comcast, and Warner Brothers. Okay, in continuation of the BoE interest rate decision, in the press conference, the Bank of England added that it expects wage increases to temper without having to increase unemployment rates. Also, one of the reasons why the inflation in UK is lagging other developed markets such as the US and EU is possibly because of the gas pricing mechanism, which is set every 6 months. Core CPI, the BoE noted, in the UK follows a similar trend as seen in the US and EU. Okay, let's move on to our financials. This week, Walt Disney announced its quarter 1 2023 results, and the company posted an earnings of $0.93 a share and $21 billion in revenue. Missed analyst expectations on EPS, but met expectations on revenue. In this post, I want to look at a comparative analysis of Walt Disney and its competition, depending on the business unit. Competition could be Netflix, Prime Video, Warner Brothers Discovery, Comcast, and Viacom CBS. This comparative analysis is a 4-part evaluation. Part 1, we look at company financials. Also, to assist me in this evaluation is a scoring mechanism, a basic scoring mechanism, which began in post 14. I call it the semi-quant. It's here to help overcome any bias while evaluating the financials. All right, part 1 is company financials. And here we look at the revenues. Comcast is the largest of these corporates with 120 billion of revenue, followed by Walt Disney at 86 billion, while Netflix, Warner Brothers, and Paramount earn between 30 and 40 billion. In terms of market cap to revenue multiple, this is one of the parameters to assess how expensive a company is. Paramount and Warner Brothers trade below their annual revenues. This does not necessarily mean that they're less expensive. It could also mean that the company is struggling. More about this as this evaluation continues. Netflix trades at about 4.8 times its revenues, while Comcast and Disney at about 1.4 and 1.9 respectively. In terms of unlevered free cash flow, which is a indication of financial health of the company, is positive for all the companies, and in the trailing 12-month period, Warner Brothers, Comcast, and Netflix have generated a free cash flow between 14 to 17%, while Disney and Paramount have generated cash flow between 9 and 4.8%. Right, earnings yield, which is the inverse of the PE ratio, is the highest for Paramount at about 40%, followed by Comcast, Netflix, and Disney. Comcast at about 7.5%, Netflix and Disney at about 3%. At the end of this part of the evaluation, Paramount and Comcast are in the lead. Okay. The next part is efficiency, valuation, and volatility. Operating income margin. You see, Comcast and Netflix have relatively higher margins between 16 and 19%, followed by Paramount and Disney at about 8%. Warner Brothers has generated an operational loss of about 7.5% in the last 12 months. PEG ratio, which accounts for a growth in earnings and price. Warner Brothers and Paramount have the lowest PEG ratios, followed by Disney at about 0.72. Debt to equity compares the amount of debt a company has to its equity. Disney has a low debt to equity at about 49%. Netflix and Paramount are at about 78%, while Comcast and Warner Brothers are at about 122 and 105% respectively. Price to tangible book value, this discounts any intangible assets. Netflix at about 16x and Walt Disney at about 27x. In terms of realized volatility, which is the volatility that the stock has seen in the last 1 year, Disney and Comcast are between 30 and 36%, while Netflix, Warner Brothers, and Paramount have a volatility between 50 and 63%. At the end of this part of the evaluation, Paramount and Comcast continue to lead. Next is part 3, which analyzes trends in financials. We look at unlevered free cash flow, diluted EPS, and operating income margin for these companies. And at the end of this part of the evaluation, Comcast and Netflix are in the lead. And in the next part, we look at valuation and dividends. Two methods to look at valuation. Investing Pro uses quantitative models to assess a fair value and potential upside. This is an objective method, while the analyst fair value estimate is subjective to the analyst. Both are important, and an average of the two tends to generally provide a reasonable indication of potential upside. According to analyst estimates, Warner Brothers has the most upside among these corporates at about 61%. And this is not something that this evaluation agrees with. On average, the Warner Brothers stock has the maximum upside potential, followed by Paramount, Disney, Comcast, and Netflix in that order. Dividend yield, Paramount and Comcast lead on dividend yields. And at the end of this evaluation, we see that Comcast and Paramount are potential additions to this portfolio, and I intend to evaluate their Q1 earnings next week and hopefully make a decision on this. In the next post, we begin with the usual weekly portfolio review and assess the Q1 earnings of the financial stocks in the portfolio. This is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. I look forward to seeing you on our website. Please visit us on www.claritech.app, and there is no subscription since this blog is free, but you can add yourself to our mailing list so we keep you updated of the latest posts. You can also visit our social media channels and subscribe, follow, or like. All right, thank you for your time, and I look forward to seeing you in the next post. Bye-bye.